I'm going to show how you can save up for a deposit for your first home starting from £0 to £46,000 saved under 5 years or less. Buying a home is one of the biggest and hardest things you'll ever do, so I'm going to help you get there as fast as possible. We look at how much money you'll need, how long it'll really take, and the fastest and most effective ways to build up the money you need to get on the property ladder. Now, some of you watching this video are probably on a good income already and could easily afford a mortgage. But the thing is, getting a mortgage usually requires a deposit, which is typically several tens of thousands of pounds. And it's like, how do you save up that much while paying hundreds in rent each month? It's not going to be easy because nothing in life worth pursuing ever is. But let me tell you one thing, right? That by having a clear and realistic plan, it's definitely achievable and definitely going to be worth it. So the first step is to work out how much you need to save. Property prices vary around the UK, but according to Halifax, the national average price of a first home is around £288,000, which, I'll be honest, sounded pretty high to me, but that's the average. Obviously, Halifax have done the research, so let's go with that number. Your deposit might be as little as 5% of this or as much as 20% or even more, but the larger it is, the better mortgage deal you're likely to get. We all assume that you want a reasonably good deal, so in this example we're going to go for 15%, which is the same deposit that I put down for my house. This means you're hoping to save up a lump sum of around £43,000. The typical first time buyer is at least 30 years old, so really the savings will or should be happening in your 20s. The average UK graduate wage, so a 22-year-old can expect to earn around £24,000, and then for this to rise by £32,000 by the time they reach 30. So this works out to an average of £25,000 over those 8 years. Assuming you can start saving by the time you start working at 22, then to save up 43k by the age of 30, you'd have to save £5,400 a year. This means putting away £450 per month, which I know is a lot, but hear me out, because I'm going to go through some ways how you can speed up that process or make it easier to save that deposit, because let's be honest, saving £450 a month whilst you're working at 22 years old or whatever, whenever you start working, is unrealistic.
We'll get back to the video in a few seconds, but 70% of you watching this video aren't subscribed to my channel. Please do me a favor and hit the subscribe button and buy more properties in the next few months. I'll be sharing everything so you can learn from my mistakes for free. Anyways, back to the video.
So the good news is that you can save up that £43,000 deposit much more quickly by using a lifetime ISA or LISA. You can open a LISA from the age of 18, paying up to £4,000 a year, to which the government then adds a 25% bonus at the end of each tax year. So if you were to put £4,000 of the original £5,400 into a LISA, because 4k is the most you can contribute, you'd have an extra £1,000 topped up by the government. Just by using a LISA, you need to be saving £1,000 less now, because instead of £5,400, it's now down to £4,400. And just remember that there are restrictions on your LISA if you want to use money for any other reason than buying a first home before the age of 60. Now that you understand how a LISA can basically give you an extra £1,000 for free, we can also start thinking about growing that pot of money. Basically, a lifetime ISA can be two things. One is a cash ISA and the other is a stocks and shares ISA. A cash LISA is the safer and more predictable option out of the two, and at the time of recording this you can find interest rates around 3 to 5%, and that's mainly because inflation is still high, and when inflation is high, usually the Bank of England offers banks higher saving rates. At the time of recording this video, I could find two pretty good ones, which were Moneybox and Tembo, formerly known as Nude. Moneybox offers 5% for the first year and then drops to 4% after that. Tembo, on the other hand, offers 4.3% throughout for 5 years. Just for simplicity, if we use Tembo's 4.3% interest as an example, if you can save that £4,000 a year or £333 a month into a cash LISA, paying you that 4.3% interest, then you'll be able to accumulate over £46,000 in 8 years. And how it essentially works is that the 4.3% interest is paid tax-free on the amount you contribute and on any government bonus that's already in the account when the interest is paid. The beauty is that you get to keep all of this interest, and the next year, right, you'll earn interest on that too, which is also known as compound interest, the eighth wonder of the world. So you basically got like £8,000 from the government and then 6,700 plus as interest, as free money. You can't really complain. It's going to get better in the next section, but before we move on, I wanted to talk about the stocks and shares LISA briefly. Now, at the time of recording this video, the interest rates on cash LISAs are pretty good. It may change in a few years time or even next year, but a stocks and shares LISA is impossible to predict, especially as investing is a long-term game and it has its ups and downs. So it could be that you may even lose money if the market drops, or it could grow and you could hit your target a lot earlier. Whatever you do, just do your research, because whether you go for a cash LISA or a stocks and shares LISA, it's all down to you, your risk tolerance and your goals, right? But now let's go through some of the options to help you get on the property ladder even faster than 8 years. If you want to trim that 8-year timescale even more, there's of course the option of buying with someone else if you can find them. A couple saving together on the national average graduate income could achieve that same deposit in just over 3.5 years. Or if you're not in that much of a rush, you might prefer doing it at half the cost over the 8 years. That way, each of you would only have to save £166 a month, or an average of 10% of your take-home salary, which to me seems pretty realistic and achievable. And it doesn't need to be a partner. You could do the same thing with a friend if you have enough confidence in each other. Get on the property ladder together, and then once you're older, you could perhaps sell the property, which has hopefully gone up in value, and then you'll naturally have a bigger deposit next time. Some mortgage providers offer joint mortgages to groups of up to 4 people as well, if that's a possibility for you. They'll usually only take the income of the 2 highest earners into account, but everyone is equally responsible for making the repayments. But if anyone wants to leave the property or sell the house, things can get a little messy, things can get a little complicated, so make sure you take legal advice before buying. Also, don't forget parents. A lot of parents want to help their children get on the property ladder anyways. So if you're in that fortunate position of being offered a cash deposit from your parents, either as a gift or a loan, then this will need to be declared to the mortgage provider, and you'll need to fill out official documents confirming the arrangement. If a gifted deposit isn't an option, you may want to look at guarantor mortgages. These let you borrow with a small or even no deposit, provided your parent or family member offers their property or savings as security against the loan, but the family member has to be willing to cover the mortgage if you do miss that payment. There's other 2 options that can help you get to your goal quicker or make it even more manageable. The first one is very popular, which is the Help to Buy loan. So if you've managed to save up a 5% deposit so far but can't save up or borrow any more to buy a property, then a Help to Buy equity loan from the government could help you. You basically put down a 5% deposit, the government loans you a set amount of equity, and you take out a mortgage on the remaining amount. The size of the government loan depends on where you live. It's 40% in London and 20% in the rest of England. The second option is shared ownership schemes that allows you to buy a share of a property. Shared ownership schemes allow you to buy a share of a property, usually between 25% to 75%, and pay rent on the rest. The main downsides are that getting a mortgage on a shared ownership property can be tricky, and it's hard to increase your share if the property's value increases. Now, I wasn't going to mention this option because I thought it would be pretty obvious to most, but I will just in case, right? I'll just mention it that, guys, if you are struggling to save money, then you may want to consider earning more money, whether it's getting a salary increase, a part-time job on the weekends, or start a side hustle. Every little helps, because remember, there's always a limit to how much money you can save, right? But there's never a limit to how much money you can make. But whilst we are on the topic of saving, there are some things where if you can make some slight additions or changes to your habits, it can help make saving for that deposit slightly easier. So I'm going to go through some of the things that have helped me personally, or some that I know have worked for others as well. Let's get the most obvious one out of the way, and that's cutting out unnecessary costs. While we all love a good takeaway, a coffee, a meal deal, the reality is it can all quickly add up. Take the money you'd spend on those each day and just put it into your saving, right? it will definitely shock you as to how quickly your savings account will grow. For example, spending £3 a day, Monday to Friday, on a shop bought sandwich, right, amounts to £7.80 a year. When you put it like that, it sounds quite a lot, doesn't it? So take a look at your monthly spending habits, write down what you have coming in and what goes out to your account each month. Then identify the areas that you can just cut back on slightly. Try taking coffee from home in a thermos flask rather than buying one at Starbucks onto your way into office, right? Or limit yourself to just one night out a month rather than every weekend. You get the idea. The next one is important because it's so simple, but it really does work, which is putting away your savings as soon as you get paid, out of sight, out of mind. Now, the good thing is that most banks these days, like Starling, which is my favorite bank, and Monzo, they allow you to have different spaces or pots within your main account. So if you start tucking your deposit into those, then it'll be less likely for you to spend it, and then you just make sure that you're on track. Bills is another one. When you start saving up for a deposit, that's the ideal time to start tidying up your finances, and there's not many easier ways to do that than renegotiating your bills and contracts. Again, it's one of those where it may not be by that much, but again, every little helps. If your landlord will allow, try switching your energy provider as well. In addition, shop around for cheaper mobile phone and broadband packages and just cancel any unnecessary subscriptions that you are using, you know, and you probably got some of them, music streaming services, gyms, clubs, whatever, right? And the thing with these services, because they face a lot of competition for customers. So if you just switch or just pretend to switch to them, or when you call them up, they'll most likely want to keep you on as a customer, right? They don't want to lose you. So on the phone, call them up, try your luck, and it's most likely that they'll give you incentives or even drop the price because they don't want to lose you as a customer. It's business at the end of the day for them as well. The final one I would say, which is a certainty to improve your saving ability, is keep a budgeting app and automate it, right? A good way of keeping on top of your income and spending habits is to use a budgeting app. It's quite simple. Every app, they're different, but they all do the same job. They all help you to manage your money by syncing up with your bank account and credit card accounts, and it just helps you keep on track of your spending. There's so many of these out there. Just take a look at the ones you fancy, check out the reviews, and most of these have free trials anyway, so you can see which one works best for you without having to pay. You can test them out, try before you buy. And whilst you're busy saving up for a deposit, there's also a few things you can do to improve your chances of successfully getting a mortgage once you're ready to apply. Mortgage lenders are more likely to say yes if 1, you have a regular income and long-term employment, 2, is if you have a good credit history, and number 3, if you are on the electrical register and have all your paperwork prepared. This isn't to say that you won't be able to get a mortgage if you're self-employed, but it could make it harder to get a decent rate, or it might just take you a bit longer. So I'll be mindful of that, because saving up for a deposit is hard enough as it is, and therefore you want to make sure you're stacking all these little things I've gone through in the video to your advantage. I hope this video has been useful, and whilst we are on the topic of getting on the property ladder, I'm going to put a link to a video on how to buy a house from start to finish, which you'll find very useful as well. Go watch that, and I'll see you soon.